first idea, Constellation Software. It's been a reliable growth story.
The growth story is nonstop, and this year it looks like the acquisitions are going to be at a record level. Mark Leonard, the CEO, said that they're going to be making larger acquisitions going forward, and they've delivered on that. Gigantic moves that they've made over the past few months, and that's really propelling the stock. Everybody's always said, inflation, it's going to be bad for growth stocks and bad for interest rates. I'm like, that's just the opposite. Companies that have pricing power, that have organic growth, they benefit from inflation. And that's exactly what happened in Constellation's recent quarterly report. Organic growth is back to a really exciting level. This is a company that's not pumping out software like Apple or Microsoft that's growing at huge rates. It's, they're buying, we'll call them mediocre businesses, average businesses, but the organic growth is there, really, because the business model is tremendous. And the stock's pulled back a little bit. I mean, if Constellation ever goes on sale, you probably don't ever want to own the stock because the business model is broken, right? But the stock has pulled back a lot because the growth continues, and we think it's a reasonable entry point to start continuing to build our positions.
Do you think computers will ever become so easy to use that we won't need experts anymore?
The computers, the AI, for example?
Yeah. I mean, they're ridiculous right now, computers. You have to, download stuff and do this and that.
Well, let me give you an example, Andy. On our site, we're going to add a chat bot. If someone sees and likes what we do, they want to ask questions about Baskin Wealth Management, first, an AI chatbot will discuss with them, but eventually a human has to start answering and qualifying the person. So I think AI is just a tool at the moment to really assist us, not necessarily to take over, but we'll see.
The Wall Street Journal had a story about a guy who's created chatbots that when junk calls come in, telemarketers, the AI will keep them on the phone to waste their time.
Great.
That's a great idea.
I hate telemarketers, but yeah.
Berkshire Hathaway is your next idea.
Yeah, so Constellation and Berkshire Hathaway, Costco and Amazon, these are like our Mount Rushmore companies. These are companies that are owner-operated mindset, generate an enormous amount of free cash flow, really just understand the art of finance. And so if interest rates are going to is this the new level for interest rates at a high rate? That's great for Berkshire Hathaway. It has a lot of float. Andy, it has $140 billion in cash. It's investing that cash right now at over 5%. That's $7 billion of free money that it didn't get a few years ago. In the meantime, the operating income from its business hit $10 billion. That's a record in the last quarter. So it's on track to do $40 billion going on a go-forward basis a year from operating income from all its businesses. Warren Buffett's going to have a lot of money to put to work, and 92, 93, he's as sharp as anybody on Wall Street.
Yeah, what is he? He eats junk food, doesn't he? He's famous for drinking Coke anyway.
Yeah, well, everybody has different genetics.
That's right.
And makeup. He lives his life and he seems to enjoy it. And
that's right. Yeah. I don't know about he drinks Coke. I don't know if he eats burgers and stuff.
Well, that's a story. We don't know what he actually does day to day, but it's a good narrative.
Yeah. And then finally, Live Nation. Again, people just want to get out and get to concerts, for example.
Not only get out. I mean, they're getting out at paying much higher prices for tickets. They're spending more money on beer, on food, on swag at the concerts. And all the artists need to go out there to make money. They don't make money on Spotify. When you listen to your favorite album, no one makes any money. They have to go on tour. Taylor Swift, she could play 300 shows a year for the next 10 years. The demand is there. Live Nation is the only company that can provide the infrastructure to help the artists and the fans get together. And the stock has pulled back a little bit, but we just see many, many years of fantastic growth for Live Nation. It's acquiring venues now. It's acquired a couple of venues in Canada, the Opera House.
They're vertically integrated?
Yeah, so they own the venues. They work with the artists. They own Ticketmaster.
Yeah.
It's an amazing business.
How are they allowed to be acquiring venues? Because, they're already a monopoly.
Well, I won't get into that. You can interview Michael Rapino, the CEO, at any time, and he'll discuss the outlook for the business going forward. Decades
ago, Hollywood studios used to own cinemas.
Yeah.
And that was broken up by the U.S. government. I guess monopolies were taken seriously in those days. Yeah.
They'll tell you that they're doing it to provide the best experience for the fans and the artists, and clearly it's working.
So you don't think a backlash by consumers? Well, yeah, people are paying these big prices. Yeah.
I mean, there's so many fragmented venues around the globe, and Live Nation knows how to run them the best and provide the best experience. And I think it's a win-win for everybody. The
two companies merged in 2010, and they reportedly control about 70% of the ticketing and live event market.
Yeah, and there is much more competition than there's ever been in the ticket business, but Live Nation is the only one that can handle, these concerts where millions of tickets go on sale for a world tour. There's no one else that can do it.
Right, and then Taylor Swift, I mean, she's good, but I'm not paying a king's ransom. But I'm not her target demo.
I'm not her target demo either. I don't even know. I think Shake It Off is the only song I know, and it doesn't interest me. But clearly, she's doing wonders for the ticket business and the concert business, and amazing, and fans love her. So may she continue to go on tour for the rest of her life.
Yeah, apparently in 2019, the DOJ did go ahead with an enforcement action, but I don't know what actually subsequently happened.
Andy, there's a lot of gigantic companies on the S&P 500 that are duopolies, oligopolies, monopoly-like. I mean, they can't help it that their business is growing, and Live Nation will tell you that they haven't done anything wrong in terms of treating the fans and the customers, and it's a business that we think has a global reach going forward as well. These festivals, these concerts, still in emerging markets is pales in comparison to the demand that's in North America. So lots of opportunities for Live Nation.
Yeah. There was the trust busting early in the last century, but politicians went after the cartels. But doesn't really happen these days, it seems.
The U.S. government allowed Ticketmaster and Live Nation to merge as long as they didn't break certain rules, and so far that hasn't been proven. So. All good.
Yeah. Okay. Barry, thank you very much. It's always great to hear from you. Let's get to those top picks. Number one, Rogers Communications. So obviously a lot of work to do there. Big debt load after acquiring Shaw.
Yeah, and I sort of talked earlier about how we like the telecom stocks in general. You own them across the board in the sector. I think Rogers probably, in my mind, offers the most upside opportunity over the next few years. A couple of reasons. One, it has the lowest dividend yield right now, but I think if they start to bring in, now that the Shaw deal is done, they'll start to pay down debt. They obviously have sold off some assets as well. They were mandated to do that. But as they do, and they start getting those balance sheet ratios in better shape, I think they're right at 5.5 times debt to operating cash flow. When you get it back down to the 3 range, you can probably start increasing the dividend again because there'll be lots of free cash flow. So, you got that upside. The valuation is lower than we've seen it in a number of years. And as I mentioned, the telecom sector in general, there continues to be growth there. I think they get very little credit for, their ability to participate in all of the growth in technology because of what's going on in streaming. Be part of it for AI. Your delivery system is still the same. It's, that's not going to change that it's the telecom companies that are basically providing, the pipes of the internet. They're the one who have built these highways. And then, like I say, what I learned from the pandemic is that the systems are very, very robust and able to handle, a lot of traffic increases in short time. So, I like the positioning, I like the valuation, I like the growth. And the sector's been under a lot of pressure. It's cheap, it's out of favor, and everyone's worried there's going to be more competition now that you've got that fourth player in the wireless. I mean, there will be more competition, which is sort of why they were forced to divest some of that. But in the end, you're not going to see collapsing prices, and it's still going to be a very profitable business for all the participants.
Your next idea is Pembina Pipeline. Why do you like this one? Because certainly TC Energy and Enbridge are out of favor.
Yeah, they have been, and that's probably a little of it, of why I like that. Look at it, the dividend yield on this is about 6.5%, so not quite as high as Enbridge and TC Energy, but a very good dividend yield. Valuation is about 10 to 11 times operating cash flow, probably more growth potential. But Andy, you're close to these situations. I think Canadian energy infrastructure has a lot of growth going forward. We're finally going to look that you have to get Canadian Canadian gas to international markets. There's going to be more shipping to the West Coast, LNG terminals growth, other things like that. Obviously, the Keystone Pipeline, never did happen, but there's still demand for oil and gas south of the border in Eastern Canada, moving it across. And I just think these infrastructure companies, the environmental issues they have to deal with are important. And, that's going to cost them a little bit more. But and there is a move to, obviously, renewable energy, but I think they, too, as well be able to sort of get into the growth in that area as well, migrating towards it. So there's a lot to like here at a 10-time operating cash flow and a big dividend yield. And on top of that, when I'm talking generally about what we see in the market and the risks right now, I'm worried about, when I'm looking at the stocks in general, I'm not looking as much, hey, what's my upside over the next years? What's the downside that I want to avoid? And I don't want to have something right now where I think I could turn around and it could be down 20 to 30%. And I think I look at a lot of, consumer cyclical stocks and others, and I think in a slowing economy, that could happen. I don't worry about as much with, a pipeline stock at that valuation. In the meantime, if nothing happens, you're still earning this, higher dividend yield.
Yeah, my numbers showing that it certainly has outperformed. It's down PPL over the past year, but it's beaten both Enbridge and TC Energy.
Yeah, they've all been out of favor. But I mean, these slower growth stocks, evaluation, just have not, certainly in the run-up this year where everyone's out of favor, AI and tech, it's been a very narrow advance focus on a few growth stocks, which surprises me given, the interest rate backdrop that we're facing right now.
And finally, BRP, the maker of recreational vehicles.
Yeah, what is funny? I sort of look at the three top picks as, like a portfolio over the next year kind of thing. And if you said to me, which of your three picks has a higher percentage, a chance of being down over the next year, I'd say this is probably the one. But it's almost like a hedge because I got two sort of defensive positions, sort of solid, slower growth companies. If the economy ends up better than I'm concerned about, BRP will do better as well. So it almost like hedges the bet a little bit and gives me some growth potential because you look at them. I mean, they're trading about 8 times multiple right now. The major competitor in the industry, the only one, Polaris, trading about 12 times. So it's a big discount to that. Yet they're taking market share away within them. Even more on the weekend, they had another show where they're continuing. I think they've beaten 8 out of the 12 last quarters, they've beaten the estimates. Like I say, they're generating free cash flow at this point. There's a big demand for these recreational products, and snowmobiles, obviously, the all-terrain vehicles, you're seeing that as well. So, yeah, the risk in the short term is that consumer discretionary large purchases like these are one of the first things to get cut in an economic slowdown. And I'm very concerned that we're heading down to an economic slowdown that the market is not sort of thinking about right now. But I think that's a bigger risk. So
yeah, it's interesting. If you look at a 5-year chart for BRP, they surged in the pandemic because people couldn't travel, so they bought these toys. And it's kind of held on to the gains.
It has, but it hasn't gone higher.
No.
When you look at the last couple of quarters, it's continued to beat the numbers. And all that's happened is the multiple has shrunk. Like I say, it's trading about, I think, under 10 times forward earnings right now. So they're continuing to deliver on this. And it's because they're picking up market share for the competitors because they're rolling out more new products. And then they're going to slowly migrate towards, the electric vehicles as well. Suddenly snowmobiles are.
That's gonna be nice.
That can be different.
A lot of people with cottages will be happy.
Cottages are gonna be gonna get the sea-doo sound out of there. Absolutely, I gotta say.
John, thank you very much. First idea, Cenovus.
We remain very bullish on oil. We see oil inventories globally ending this year at an 8-year low. And we think oil is firmly supported at $80 oil with a shot at $100 by the end of this year. And so we're looking for leverage to that call. Cenovus is our number one large cap pick. It trades at a material discount relative to its peers. It's quickly getting to the threshold where they'll be paying us 100% of their free cash flow versus 50% now. We have the name trading at a 17% free cash flow yield at the current oil price, and if we're directionally accurate at $100 oil next year, 22%. So you get a large cap name with a bulletproof balance sheet, 30-plus years of stay-flat inventory, a new CEO, but he's been around, everybody knows him, everybody likes him for good merit, with a company that we think is going to be able to pay us a 17% dividend annualized by Q2 of next year, or a combination of dividend and share buyback. So we just think it's incredibly mispriced at 4 times cash flow at the current oil price. We think it should trade up to 6, if not higher. which lends itself to 50 to 100% upside at $80 to $100 oil.
Sorry, you said a 17% dividend annualized.
Yep, so by Q2 of next year at $80 oil, they'll reach their debt target, they'll inflect to 100% of free cash flow, and then they'll decide what to do with it. So if it was a dividend, 17% yield. If it's all buybacks, 17% buyback per annum. It's probably going to be a combination between those two. But our thesis is this sector re-rates to a 10% plus free cash flow yield. You pick the oil price, wherever it's going to be. So at the current oil price, you go from 17 to 10. That's a material uptick in the share price to discount just at 10%. We think that's being very conservative.
Crescent Point.
Yeah, so this is a new name for us relatively. We've been in this in the past, but our knock on it was always inventory depth. And where our thesis was, well, they're going to have to go do M&A, similar to a Tamarack. There'll be an overhang to the story, et cetera. And I think we were proven to be correct because they went out and were very aggressive acquirers in the Montney and the Duvernay, pivoting from old tire production in southeast Saskatchewan, of which they just sold a little bit more overnight and got rid of almost a quarter of their abandonment liabilities after selling like 700 barrels. It was a phenomenal divestment. We like Crescent Point because after Baytex, which would have been a top pick, but it was a prior top pick, it is the second highest free cash flow yield of companies that we follow.
Wow.
So with the current oil price, it trades on our math at a 25% free cash flow yield. They're not quite as aggressive. The board and CEO, they're more tame in some regards. So we're only getting half of that. But that's still a material dividend/buyback combination. Meanwhile, they continue to deliver with the remaining and maybe further acquisitions down the road, which they've proven themselves to be pretty good. And that one knock on the company has always been inventory depth. Now they believe 15 plus years of stay flat, like tier one quality inventory. So that's no longer a concern. We've got it trading at 2.6 times at the current oil price, 2 times at 100. So let's just run with the current. At a 5 multiple, that's 135% upside from here. We would put a $25 target on the share price. So we see next to Baytex the highest free cash flow yield, and I would say the most upside potential if they can buy back their stock anywhere near the current oil price.
And then finally, Athabasca Oil, a classic heavy oil play.
Yeah, so this is a huge weight for us. It's about a 10% weight. It's done very, very well this year. And anytime I've been tempted to materially trim, I pull up my spreadsheet. I'm like, well, why would I sell a lot of the stock? Because at $80 oil, it's trading at a 19% free cash flow yield. Due to some very good divestments, they reached the point where they've inflected to 75% of that free cash flow coming back to us, a minimum. They're actively buying back stock aggressively. I get exposure to meaningful heavy oil, which I'm very, very bullish on, not just oil, but on WCS, so Western Canadian Select, with TMX coming online either at the end of this year or early Q1. It sounds like there might be maybe like a month or two of slippage. So I look at a name, well, I'm getting 35 plus years of inventory. I'm only paying for 5 of them. They're debt-free, we think, by the end of this year. So the balance sheet, what was one of the most over-levered names, they were on the precipice of bankruptcy at one point. Now they're in a net cash position. So they have so much optionality in the portfolio. So we say, okay, if it gets to a five times multiple, you're looking at 50 to 100% potential upside at $80 to $100 oil, which shows you the amount of leverage you get to a rising oil price.
And a weak Canadian dollar, presumably, is good for MEG and Athabasca.
Absolutely. Yeah, I would consider myself a global energy investor. In my main fund, we're 100% Canada. Canada is where I want to be. I'm getting the longest reserve lives of anywhere in the world outside of Saudi Arabia and Venezuela. I'm getting the lowest declines. I'm getting the strongest balance sheets in their history. I'm getting the most amount of free cash flow in their history. And most importantly, a commitment that once they reach their final debt target, they will get approximately 75 to 100% of that free cash flow. And if it all goes into buybacks, and if you can privatize in 4 or 5 years, it must force the re-rating. So I know people have been impatient. It's been an exhausting wait. We're almost there in terms of companies being able to do those meaningful share buybacks.
Eric, thank you very much. Okay, let's get to these top picks. We could talk about this one all day. This is an ETF that's a bullish bet on interest rates going down, essentially. So this is the Direction Daily 20-year Treasury Bill 3 times.
Right. And keep in mind that 3 time, when we're talking about the bond market, it's not as volatile as stocks. So to get the same sort of level of volatility as a stock, they do the 3-time leverage.
Okay.
Keep in mind, though, this is a very, very risky investment because the bond markets are going through so much turmoil with interest rates. The 20-plus year range is where inflation expectations occur.
Yeah.
So that's more fiscal policy rather than the short-term monetary policy. So we're really looking at this is a bet on inflation declining. Yeah. And so we're seeing some indicators with personal consumption, cost of different commodities going down. Like there's a few exceptions, like beef. That is record highs right now. And if you go try and buy anything, hamburger even, it's expensive. So I think inflation is going to go down. I think it's topped off, and I saw some topping patterns in the yield markets. So big reversals recently. So that plays into this recommendation. Keep in mind, though, it's a small investment. This is not something where you're going to put 10 or 20% of your money into by any means. This is more like a 3 or 4%, and then you build. So this is, again, play on inflation going down. We probably will see inflation around the 3%, so we'll have a 3 handle on it, so 3-point-something% for the rest of the year. And I think probably go back down to the 2-point-something% range next year.
You think they'll get down towards that target range
yes,
again?
Yeah, in North America. We're not talking about Europe. There's other issues in different places, but definitely consumer spending is going down, and that puts there's a lot of factors that go on into this, and it's just many, many factors. But that's the sort of the bottom line analysis.
No, you explained it really clearly, if I may say so. Carnival, the cruise line, you see promise here.
Yes, so this is obviously, everybody knows the problems with cruise lines and the pandemic. They were shut down. The stock bottomed down around $8. I was picking it up around 10. And so in a profit position right now, this pullback that we've seen from about $19 and change down to where we are now, I think is an opportunity. I think it probably is going to stay around the $15 level until some more information comes out. But a lot of people are going back. Of course, you got this big bulge of people, airlines, like anything related to vacations. Everybody's getting back. So it's really how sustainable is that, and how much is that going to continue? So I think it's going to continue. And this is kind of a good ticket for a vacation. And despite anybody, what people think about, getting diseases or whatever on cruise lines, I don't think that's a problem with this. I think everybody's happy to get back and going to continue trading or being in this type of vacation package here. So.
Okay, and then finally, Gibson Energy, a big player in oil storage and transportation. This stock, last time I looked, was under pressure. Down about 23% in the past year, but you like the look of it.
Yes, well, a broker that I work with, Andrew Getz, if you don't mind mentioning, well, it's too late now, I've mentioned his name, but showed this to me recently, and I really like it. I think I'm going to be buying this, and it's trading down to the support level. The yield is very high. It's a yield play. They've done a transaction in Texas, which should add to their top lines and bottom lines. So I think overall, it's got all the sort of factors that I am looking for. Again, it's a yield play, right? I'm looking for yield stocks right now, and so this is top of the list for me.
Yeah, so they just bought that South Texas Gateway Terminal. So like Enbridge, they're going to be big players in oil tanks in that part of the world.
Right.
And I think at the start of this month, they had disappointing earnings, and part of that was a provision for an environmental cleanup. So that may be a factor.
That was pretty minor in the big picture.
Yeah. And then let me just check the yield here. Oh, there we have it. Thank you, control room. 8%. Okay.
Right. So it's a good time to be locking in these yields right now.
But Jeff, I hope it's not another. You come back sooner than 3 years.
Well, you call me.
Okay, we'd love to have you back, and thank you very much.
Glad to be here again.
First idea, Fortis electric utility.
Yes, that's right. Boring utility, but they've been out of favor because once again, utilities are interest-sensitive stocks. They've pulled back, and Fortis here now at whatever $54, around that $54 level, I think is quite attractive. It gives you a yield of 4.2%, so not the highest yield, but it's still higher than a, let's say, 10-year Treasury bond, and I'd much rather own Fortis because I think they're going to grow their dividend 46% for the next couple of years. That's what they've guided to, and I think their share price will also move up a little bit over time as well to get a total return in that 10% range, but very visible cash flow streams, highly visible defensive cash flow streams, because 99% of their assets are regulated, so they get a return on those. And we think, they investment grade balance sheet. And when you think about where we're going in terms of decarbonization, electricity demand is only going to increase. And so they do transmission and distribution of electricity and gas. So, their networks are going to have to, modernize, grow their networks. So that's going to be beneficial for capital plans.
Royal Bank of Canada beat expectations this week.
That's right. They reported yesterday, and we do like the Canadian banks. We think that the valuation levels reflect a lot of the bad news. Royal, they were able to grow their loan book, not a lot, but they still grew it. And in terms of their net interest margin, it actually expanded a little bit. So they're saying that a lot of we're seeing kind of the margins are being squeezed because a lot of the customers are now taking money out of their checking accounts and going into GICs or term deposits, which pay higher interest rates. And so that was squeezing their margins more in the last few quarters. They feel that a lot of that movement has happened already. And in fact, they are gaining market share, they said, in the GIC market. So they're actually getting new clients who are buying their Royal Bank GICs who are not Royal Bank customers. So the hope, I guess, is that when these GICs mature, they can cross-sell and keep them in the Royal Bank system. So that's positive. And as well, HSBC, they've announced the acquisition of HSBC. That's under regulatory, hasn't been approved yet. They're hoping to have that closed by early 2024. I think when that closes, that's going to be another source of growth for the company, especially in terms of HSBC has a very international-oriented client base, so that will help them. And as well as along with the other big Canadian banks, they will benefit with the inflow of immigration into the country. Many of them are going to be needing, bank accounts as well and various credit products. And Royal is going to be right there trying to get them.
Okay, and then finally, WSP Global, the engineering firm.
Yes, so global engineering design and services firm. They do not have construction exposure, which is one of the reasons why we bought this company a few years ago. Construction is usually the areas the engineering firms get in trouble with. So WSP Global, they grow through acquisition, so they've done very well. They've made some very nice acquisitions the last few years to expand their presence in attractive verticals like environmental, infrastructure, et cetera. But they're also now posting pretty nice organic growth in terms of their backlog growth. So when they reported their numbers a couple of weeks ago, nice backlog growth. And they're also saying their soft backlog, which they characterize as orders that they have, but they're still waiting for financing. They don't put that in their official backlog, is actually up about 40% in the United States. So, Andy, I talked earlier about those stimulus packages that the government has announced in terms of infrastructure and even the Inflation Reduction Act. I think WSP Global is well positioned to benefit, to get business from those policies. They're going to start seeing that business flow through their order book in the next couple of years. And once again, they're also always looking for other acquisitions around the world. Very also disciplined on pricing, on what they pay. In the past, they have actually walked away on acquisitions if it gets, the bidding war gets too high. So we think right now they've got a nice balance of both organic and growth through M&A.
They've been known to just fold up their papers and walk out of the office. Yeah,
yes.
always a good tactic as well. Yeah.
Yes.
Christine, thank you very much indeed.
Thanks, Andy.